Welcome to Griffonomics.
Glad to be here.
So, imagine being handed a $3 billion war chest,
Wow.
right, by the Pentagon and massive private equity firms just to build this sprawling industrial empire.
Yeah.
Even though your company generated less than $2 million in revenue last year.
Sounds like a typo, honestly.
I mean, it really does. But today is April 3, 2026, and for you listening, we are not looking at a standard corporate growth story today.
No, absolutely not.
We aren't analyzing a company trying to squeeze out a few incremental percentage points of market share. We are looking at an entity attempting to essentially buy America's way out of a geopolitical chokehold.
Yeah, it's a monumental task.
So today's deep dive is going to be a granular strategic report, an actionable investment roadmap into a company trying to single-handedly rewire global trade.
And the company in the crosshairs today is USA Rare Earth, or USR.
Right.
Over the last year, they have been undergoing this fundamental transformation. I mean, they are morphing from a pre-revenue exploration entity into what they intend to be the very first fully integrated domestic supplier of permanent magnets.
And the numbers driving this transformation are just wildly disproportionate.
Oh, yeah.
As of early 2026, a company with basically no historical revenue is sitting on approximately $1.75 billion in cash.
It's staggering.
They are acting as a literal proxy for U.S. national security. So we are going to tear apart these recent SEC filings, the financial reports, the market analyses.
Because we really need to figure out exactly how this hypercapitalization is happening.
Exactly. What are they physically building? And ultimately, is this the ultimate geopolitical value play for your portfolio, or an absolute execution disaster waiting to happen?
Well, to understand the influx of all that capital, you first have to understand the physical blueprint.
Right.
Because right now, China currently holds a 90% plus monopoly on rare earth processing and permanent magnet production.
90%?
Yeah, over 90. And USR's entire business model is designed to break that specific monopoly. They're using this highly complex four-stage value chain.
The mine-to-magnet integration.
Exactly, the mine-to-magnet integration.
But let's lay out that geographical footprint because it is massive. The whole thing starts upstream in Sierra Blanca, Texas.
Right, at the Brown Top deposit.
Yeah, that is their flagship mining project.
Yeah.
And recently, USR executed a $73 million all-stock buyout of Texas Mineral Resources Corp.
PMRC.
Right. Just to secure 100% operational control of that mine. So, step one, pull the raw material out of the Texas dirt.
But, pulling rocks out of the ground doesn't give you a magnet.
No.
And that brings us to the midstream processing, which is arguably the most difficult part.
Okay.
They have a hydromet demonstration facility in Wheat Ridge, Colorado, where they're refining the chemical separation of these elements.
Right, the chemistry lab phase.
Basically, yeah. Then, in late 2025, they spent $100 million in cash and equity to acquire a UK-based company called Less Common Metals, or LCM.
Wow. Yeah.
And LCM handles the actual metal making and alloy strip casting. And they're already planning to expand that footprint into Lac, France.
All of which feeds into the final downstream stage, right?
Right.
This massive 310,000 square foot magnet manufacturing plant in Stillwater, Oklahoma.
That's the one.
I want to pause here because this single building in Oklahoma essentially represents the entirety of America's defense supply chain hopes.
It really does.
Okay, let's unpack this. You've got rocks in Texas, chemistry labs in Colorado, alloy forging in Europe, and manufacturing in Oklahoma.
Yeah.
I mean, stretching a brand new, highly technical supply chain across 2 continents seems like an administrative nightmare. Aren't they biting off way more than they can chew by doing all 4 stages at once instead of just specializing?
If we connect this to the bigger picture, being vertically integrated here is a strategic necessity. It is absolutely not a luxury.
Yeah.
Well, think about the geopolitical reality of rare earths. If USR decides to play it safe, right?
Yeah.
And they only build the mine in Texas and the magnet factory in Oklahoma.
They leave a gaping hole in the middle.
Exactly. They would have to send their raw Texas ore to China to be chemically processed and forged into metal alloys.
Oh, wow. Just to buy it back to make magnets in Oklahoma.
Yes. Which means China retains total control over the choke point.
Right. Beijing could simply decide to halt the export of processed rare earth alloys, which they already maintain strict export controls over anyway.
Exactly that. The moment they do that, USR's multi-billion-dollar mine and their massive Oklahoma factory come utterly useless.
So they have to own the entire chain.
From the dirt to the final product, just to protect themselves from supply weaponization.
Yeah. So the blueprint is geographically staggering, but a map doesn't produce high-tech magnets.
Right.
We need to look at the timeline, because USR is hitting a major strategic inflection point right now in 2026. This is no longer just a theory on a whiteboard.
No, it's happening. In Q1 2026, just recently, USR commissioned Phase 1A of that Stillwater, Oklahoma facility.
And we're looking at a target for their first customer magnet fulfillment right now,
Okay.
in the second quarter of 2026.
Yeah, Q2.
Let's talk about the scale they are aiming for, because the filings are incredibly aggressive. Like, how fast are they trying to ramp this up?
Very fast. They are targeting a run rate of 600 metric tons of permanent magnets per year by the fourth quarter of this year.
600?
Yeah, and they plan to double that to 1,200 metric tons per annum by 2027.
Wow.
And to support that massive manufacturing surge, they also initiated an accelerated mining plan, the AMP.
Right, the AMP.
They're trying to bring commercial production at the Round Top mine forward by 2 full years. They're targeting late 2028 now.
That acceleration is critical.
Yeah.
We should really talk about what is actually buried under Round Top, because it is not your standard rare earth deposit.
Not at all.
In this industry, you basically have light rare earth elements and heavy rare earth elements. And most of USR's Western competitors, they're digging up light rare earths.
Mostly, yeah.
But Round Top's mineralogy is incredibly unique. About 72% of its rare earth oxide basket consists of heavy rare earth elements, things like dysprosium and terbium.
Yes.
Why is that heavy basket so crucial to this whole master plan?
It really comes down to one word: heat.
Heat?
High-performance permanent magnets, the ones powering F-35 fighter jets, advanced robotics, EV motors, they generate immense amounts of heat.
Right.
If you build a magnet using only light rare earths, it literally loses its magnetic properties at high operating temperatures.
Oh, it just demagnetizes.
Exactly. You absolutely need heavy elements like dysprosium and terbium to stabilize the magnet under extreme thermal stress.
Okay, and USR is also deploying some specific technological innovations, right, to stretch those expensive heavy elements further.
Yeah, they use a manufacturing technique called grain boundary diffusion.
GBD.
GBD, right?
Right.
How does that work? GBD is a fascinating process. Think of a magnet under a microscope as a wall made out of millions of tiny magnetic bricks.
Okay, tiny bricks.
Historically, to make a magnet heat-resistant, manufacturers had to mix heavy rare earths into the entire brick.
Like baking it into the clay.
Right. But with grain boundary diffusion, they only infuse the heavy rare earths into the tiny gaps between the grains. It's like only using the expensive material for the mortar holding the bricks together, rather than building the whole brick out of it.
That makes so much sense.
It drastically reduces the total amount of dysprosium and terbium needed while still maintaining that top-tier temperature performance.
And they're innovating on the mining side, too.
Right.
Like, instead of traditional hard rock milling, where you blast rocks, crush them into fine powder, roast them in massive kilns.
Very carbon heavy.
Yeah. They're utilizing heat bleaching and proprietary solvent extraction.
SX.
Yeah, FX Tech. They basically pile the ore, run a dilute acid through it to dissolve the minerals, and use recyclable solvents to separate the elements. It's drastically less capital intensive.
And way less of an environmental nightmare.
Exactly. But here's where it gets really interesting. Let's look at the timeline again.
Okay.
If the Oklahoma factory is pumping out finished magnets right now in Q2 2026,
Yeah.
but the Texas mine doesn't open until late 2028, what exactly are they making these magnets out of today? Thin air.
No, and it is the most glaring vulnerability in their entire operational plan.
Right.
Financial analysts call this the execution gap. Right now, USR is functioning strictly as an advanced manufacturer relying entirely on third-party raw materials.
Because their own upstream supply in Texas isn't online for another 2 years.
Exactly. So they are forced to buy mixed rare earth carbonates and processed metals on the open global market.
Oh, wow.
Yeah, they feed those purchased materials into their European LCM subsidiary to make the alloys, and then they ship those alloys to Oklahoma.
Wait, if they are buying from the open global market, and China controls 90% of that market,
You see the problem.
they are essentially buying from their main geopolitical rival just to keep the lights on.
Yes.
I mean, running massive manufacturing facilities on third-party raw materials while trying to simultaneously build a multi-billion-dollar mine in Texas,
Yeah.
that has to create an intense cash burn.
Oh, absolutely.
If they have to survive this 2-year execution gap, how are they funding it?
Well, let's look at the financial realities from the fiscal year 2025 review,
Yeah.
because they are staggering.
Go
The
for it.
company reported a revenue inception of just $1.64 million.
$1.64 million.
And to be crystal clear, that revenue wasn't from selling magnets. It was derived entirely from the few weeks they owned their new UK subsidiary, Less Common Metals, at the end of the year.
Right. And against that tiny revenue, they reported a massive net loss of $298.5 million.
Yeah.
Though, if you are an investor looking at that filing, don't panic immediately. Digging into the cash flow statement reveals that $244.5 million of that loss was from non-cash fair value adjustments on financial instruments and warrant liabilities.
Let's define that for the listener so it doesn't just sound like accounting jargon.
Yeah, please.
A warrant gives an investor the right to buy stock at a certain price later. If the company's overall value changes, accounting rules require them to record a quote-unquote loss or gain on paper based on what those warrants are now worth.
So it's just pure math on a spreadsheet.
Exactly. It is not actual cash leaving the company's bank account. Their true actual operating cash burn last year was about $49 million.
Okay, but even at a $49 million cash burn against $1.6 million in revenue, their balance sheet should be screaming distress.
You'd think so.
Yet, following a $1.5 billion private investment in public equity, a massive PIPE deal that closed in January 2026, their cash balance surged to $1.75 billion.
It's wild.
And that's just the private side. That same month, they secured a $1.6 billion letter of intent from the U.S. Department of Commerce under the CHIA-PS Act.
Right, the CHIA-PS Act.
That package includes $277 million in direct grants and $1.3 billion in senior secured loans. So what does this all mean? I mean, they generate the revenue of a successful local restaurant, burn through $50 million bucks, and are suddenly handed $1.6 billion by the government and $1.5 billion from private equity.
Yeah.
That's like a neighborhood lemonade stand, getting venture capital funding from the Pentagon simply because they set up shop on a strategically important street. It completely defies standard market logic.
What's fascinating here is that traditional financial metrics, price-to-earnings ratios, historical cash flows, standard valuation models, they simply do not apply to USR.
Right.
You cannot analyze them the way you would analyze a standard mining operation or a tech startup.
Because the rules are different here.
The U.S. government and these massive private equity funds are underwriting this risk because USR has been effectively classified as a national security asset.
They aren't investing in a company. They are buying strategic independence.
Exactly.
But pouring billions into a company doesn't guarantee its survival, especially when your primary competitor is a state-sponsored monopoly. What is stopping China from just temporarily crashing the price of rare earth magnets to drive USR out of business before the Texas mine even opens?
That is the exact tactic monopolies use, market dumping.
Yeah.
China could flood the global market with artificially cheap rare earth metals, operating at a massive loss simply to starve nascent Western competitors of revenue until they go bankrupt.
Right.
But the government is establishing massive strategic moats to prevent that. The U.S. trading bloc is developing a price floor system.
Explain how that mechanical floor works in practice.
Essentially, if global rare earth prices drop below a certain threshold due to Chinese dumping, Western governments will step in. They'll subsidize the difference or place heavy tariffs on the cheap imports. This artificial price floor is designed to guarantee a minimum internal rate of return for Western producers like USR.
So it ensures they stay solvent even if the global market price collapses.
Precisely.
And it isn't just price protection. There is also the DFARS mandate, the Defense Federal Acquisition Regulation Supplement.
Oh, this is huge.
Yeah. Starting January 1st, 2027, the U.S. Department of Defense is legally banned from procuring any permanent magnets that originate in China.
Which is a monumental demand catalyst. The U.S. military is one of the largest consumers of high-performance magnets in the world.
Right.
By legally forcing defense contractors to buy from non-Chinese sources, the government is essentially creating a captive premium market for whatever USR produces.
The demand isn't just projected. It is guaranteed by federal law.
Exactly.
But when the government and private equity firms drop over $3 billion on your desk to fight a geopolitical trade war, they don't do it out of charity.
No, they definitely don't.
There are massive strings attached. If you are a retail investor looking at this stock, we need to talk about the dark side of this balance sheet and the severe execution risks, because the market skepticism is very real.
It is, and the skepticism centers heavily on dilution.
Right.
To fund this $4.1 billion overarching vision, the equity structure of USR has been aggressively expanded. A year ago, the share float was around 60 million shares.
Okay.
Following the reverse merger to go public, the massive PIPE issuance we mentioned, and the various acquisition payouts, that float has exploded to 217.9 million shares.
Think about what that means for your portfolio.
Yep.
If you are holding this stock right now, you have to look at that dilution and realize your slice of the pie just shrank by over 70%.
Yeah, it's brutal.
And the government terms attached to the CHIPS Act funding are particularly striking. As a condition of the funding, the U.S. government takes a massive equity stake, 16.1 million shares and 17.5 million warrants.
Yeah.
But here is the kicker. According to the SEC filings, the government retains 100% of this equity, even if the CHIPS Act funding falls through or is clawed back due to missed milestones.
That's crazy.
Hold on, the government gets to keep their shares even if they cancel the deal? That is like giving the bank the deed to your house, just as a fee for applying for a mortgage. How does a retail shareholder ever benefit from terms that punitive?
This raises an important question about the true cost of government sponsorship. A provision like that is highly irregular in standard finance, and frankly, it is incredibly punishing to retail investors if the company stumbles.
Seriously.
And the hurdles are high.
Mm-hmm.
That $1.6 billion isn't handed over in a single briefcase. It is milestone-based.
Right.
To unlock all the tranches of the CHIPS Act funding, USR is contractually required to go out and raise an additional $600 million in equity by 2027.
Oh, wow.
So if you are an investor today, you know for a fact that even more dilution is coming down the road. There is also a layer of structural skepticism surrounding how they went public in the first place. We need to touch on the SPAC controversy.
Okay. Yes.
USR entered the public market through a special purpose acquisition company, backed by Cantor Fitzgerald and Howard Lutnick.
Right. And SPACs inherently carry allegations of structural conflicts of interest.
Right.
The critique is that SPAC sponsors, in this case, Cantor Fitzgerald, often receive massive payouts and heavily discounted shares simply for facilitating the merger.
Regardless of how the stock performs for the retail investor afterward.
Exactly. Analysts have pointed out that this structure allowed insiders to secure massive equity positions before the retail market was fully exposed to the execution risks.
Speaking of execution risks, we cannot forget the feedstock reliance issue, that 2-year execution gap we discussed earlier.
Right.
For the next 2 years, the Stillwater magnet plant is utterly dependent on third-party raw materials.
Which leaves them exceptionally vulnerable. I mean, China doesn't even need to dump cheap magnets to hurt them. They could simply restrict the export of the specific midstream raw carbonates that USR needs to purchase today to run their Oklahoma plant.
Oh, of course.
If Beijing cuts off that feedstock before the Texas mine is fully operational in late 2028, USR's state-of-the-art factory floors grind to an absolute halt.
You can see exactly why some major analysts are rating this stock a hold rather than a screaming buy.
Absolutely.
The sheer execution risk of constructing multiple massive facilities across the globe while managing a highly vulnerable temporary supply chain is staggering.
It really is.
Retail investors are being asked to absorb an unprecedented level of dilution to fund what is essentially a national industrial experiment.
It is a profound high-wire act.
Yeah.
You have the ultimate geopolitical tailwinds, a captive defense market, and billions in government backing.
Yeah.
Balanced precariously against extreme capital requirements, severe shareholder dilution, and immediate supply chain vulnerabilities.
So weighing these incredible government moats against the sheer weight of the execution risks and the dilution, we need to arrive at a bottom-line verdict for the listener's portfolio. What is the actual play here?
When you synthesize all the filings in the geopolitical context, USR must be rated as a speculative buy, or more accurately, an event-driven play.
Event-driven.
Yes. If you are an investor, you must divorce this from traditional fundamentals. USR acts entirely as a geopolitical proxy.
Right.
Its future success is tied far more to overarching U.S. trade policy, the strict enforcement of the 2027 DFARS defense ban, and whether they can hit the specific milestones required for the CHIPS Act disbursements.
Much more than it is to traditional mining cycles.
Exactly. If you buy USR, you are placing a calculated high-risk bet on the permanent geopolitical fracturing of global trade.
And as you evaluate that bet for your own portfolio, here is a final provocative thought to chew on.
Okay.
Consider the deep, unavoidable irony of USR's current operational reality. They were built to secure American independence, Yet, for the next 2 years, in order to survive the execution gap and keep their new factories running, USR's production actually depends on buying the very foreign raw materials they were designed to replace.
It's crazy to think about.
This means that, theoretically, their primary rival holds the ultimate power to dictate the terms of USR's rise before that Texas mine ever opens its doors.
It is a precarious window of vulnerability. I mean, they are tasked with securing the future of American manufacturing, but they have to walk through the fire to get there.
Risk defined, portfolio protected.